Canada, a longtime energy ally of the United States, has suddenly shut down a $13 billion oil pipeline, catching Washington completely off guard. The country has officially halted the export of oil and gas to its southern neighbor. As the largest supplier of energy to the U.S., Canada's decision triggered immediate consequences. Prices for gasoline, oil, and electricity began to climb nationwide, disrupting daily routines and straining household budgets. The cost of living is rising across the board. Commuting expenses are up, airfare is becoming less affordable, and energy-intensive industries like transportation and manufacturing are facing serious challenges just to stay operational. This move didn't come without warning. For years, the U.S. had placed heavy tariffs on Canadian exports, assuming there would be no serious backlash. That assumption no longer holds. Canada responded by ending energy exports to the U.S. and redirecting its focus toward new partners. Long-term energy agreements were signed with China and India, two of the largest and fastest-growing energy markets in the world. It's not just about retaliation. Canada is taking a broader economic approach, looking to expand its global influence and reduce its dependency on the American market. The country's pipeline infrastructure is now being reoriented toward Asia and Europe. The energy shortfall in the United States has grown into a full-scale crisis, leaving the country scrambling for alternatives. States like New York, California, and Michigan are at risk of rolling blackouts, particularly during winter months. Electricity prices have soared, and some areas are considering peak hour usage limits to prevent grid overloads. Industries reliant on stable, affordable power are cutting back production. Auto manufacturing, steel plants, and food processing facilities are laying off workers and reducing output. Thousands of jobs are now in jeopardy. Households and businesses alike are facing higher costs for gas, electricity, and everyday goods. Inflation is surging, and federal efforts to contain the situation appear to be falling short. The energy shortfall in the United States has grown into a full-scale crisis, leaving the country scrambling for alternatives. States like New York, California, and Michigan are at risk of rolling blackouts, particularly during winter months. Electricity prices have soared, and some areas are considering peak hour usage limits to prevent grid overloads. Industries reliant on stable, affordable power are cutting back production. Auto manufacturing, steel plants, and food processing facilities are laying off workers and reducing output. Thousands of jobs are now in jeopardy. Households and businesses alike are facing higher costs for gas, electricity, and everyday goods. Inflation is surging, and federal efforts to contain the situation appear to be falling short. The fallout is not just economic, it's becoming political. A nearly $19 billion energy agreement between the U.S. and Canada is now in limbo. Former President Donald Trump has proposed slapping a 100% tariff on Canadian auto imports, a sector that plays a vital role in Canada's economy. As friction between Washington and Ottawa grows, Europe is moving ahead with its own defense initiative, an $800 billion plan to strengthen its military capabilities. Trump issued strong warnings during a Fox News interview, demanding that Canada take action on border issues or face tough consequences. Prime Minister Mark Carney responded with firm language, declaring that Canada would not surrender its sovereignty to U.S. pressure. He also dismissed past comments by Trump suggesting that Canada could become America's 51st state, calling the idea absurd. In response to mounting tensions, Canada is now reviewing its F-35 fighter jet purchase, despite already ordering 16 units. As tensions rise globally, the European Union is taking unprecedented steps to redefine its role in global security. Under the banner of a new initiative called Rearm Europe, EU leaders are working to break free from long-standing limitations, both financially and strategically. This ambitious program seeks to remove budgetary caps, significantly increase weapons manufacturing, and build a defense network less dependent on the United States. This marks a pivotal shift in the continent's defense posture. With the war in Ukraine still casting a long shadow and rising concerns over future conflicts, the EU is racing to ensure that it is not caught off guard. A top defense industry leader has projected that Europe's collective military expenditure could soar to over $1 trillion by 2030, a figure that would place the bloc on par with traditional military giants and establish it as a formidable force on the world stage. Beyond economics, this strategy reflects a deeper transformation, a move toward military self-sufficiency, and a more unified European defense identity. For the first time in decades, Europe appears ready to assert itself, not just as an economic superpower, but also as a global security player in its own right. Despite maintaining its formidable military capabilities, the United States is no longer the uncontested leader it once was in the eyes of its allies. The shifting tides of international politics, regional conflicts, and emerging powers are prompting traditional U.S. partners to reassess their long-term alliances. In places where Washington's voice once carried unquestionable weight, there is now a growing sense of independence. Countries are choosing to diversify their strategic partnerships, balancing between the U.S. for rising powers like China and increasingly assertive regional blocs. Even within NATO, disagreements over spending, burden sharing, and collective priorities are becoming more pronounced. This subtle yet profound shift reflects a world that is no longer unipolar, a world where loyalty to Washington is not automatic, and where nations are charting their own strategic paths based on regional interests rather than ideological alignment. Amid growing instability, former President Donald Trump held a press conference that quickly stirred controversy and concern. Rather than calming the nation, his remarks introduced a series of bold and polarizing proposals that deepened the public's unease. He raised the possibility of withdrawing from NATO, a cornerstone of American foreign policy since World War II. He also hinted at escalating economic protectionism, suggesting higher tariffs that could strain international trade relationships, along with major cuts to domestic social programs. But perhaps the most startling moment came when he questioned whether NATO allies would come to America's aid if the roles were reversed, casting doubt on the very alliance that rallied behind the U.S. after the 9/11 attacks. The press conference marked a turning point in the public discourse, with critics warning that such statements could isolate the U.S. at a time when unity with allies is more crucial than ever. For many, it signaled a potential unraveling of post-war alliances and raised difficult questions about the future of America's global leadership. Trump didn't hold back. He firmly repeated his position. If a NATO country fails to meet its defense spending obligations, the U.S. won't step in to protect them. I told them that, he said. When asked whether this was official U.S. policy, Trump stood his ground and doubled down on his stance. When asked if this reflected official U.S. policy, Trump didn't back down. Instead, he doubled down with even more conviction, making it clear that he meant every word. These statements directly challenge NATO's fundamental principle of collective defense, where all members agree to stand together in the face of aggression. So, is Trump seriously considering pulling the U.S. out of NATO? Or is this simply a high-stakes pressure tactic? At the same time, Trump defended his economic policies, insisting that the current inflation is only temporary. He claimed that, in the long run, farmers would actually benefit. At the same time, Trump temporarily reversed his own tariff policy, lifting tariffs on certain imports from Canada and Mexico for 1 month. The move was a strategic attempt to pressure both countries on immigration enforcement and the fight against fentanyl smuggling. But here's the issue. Trump has repeatedly shifted his stance on tariffs, leaving many businesses in a state of confusion and uncertainty. Is he truly safeguarding the U.S. economy, or is he simply stirring up more chaos? One of the more unexpected moments during the press conference came when Trump signed a proclamation honoring Women's History Month. He then claimed that his administration had done a lot for women, a statement that raised eyebrows given the broader context of his policies and rhetoric. But the reality is, this is the same man who has faced numerous allegations of sexual assault, the same man who was caught on a leaked tape bragging about groping women. Despite that, Trump shifted gears and announced that his administration would continue supporting initiatives aimed at empowering women in the workforce and promoting leadership opportunities. The announcement was met with mixed reactions. Some saw it as a step in the right direction, while others viewed it as a hollow gesture from a president whose past actions and statements have repeatedly undermined the very cause he claimed to champion. In a scene that felt almost surreal, former President Donald Trump stood before cameras, grinning ear to ear as he proudly showed off a brand new luxury vehicle. "I'll use it at the White House. I'll let my staff enjoy it too. I love driving, though they won't let me," he quipped, relishing the moment like a celebrity unveiling a prized possession. But beyond the polished chrome and the well-rehearsed smile, the nation's economic engine was sputtering. Wall Street, the heartbeat of American financial confidence, was in a tailspin. The Dow Jones Industrial Average plunged by more than 850 points, erasing billions in value in just one trading day. Meanwhile, the S&P 500 took a 2.3% hit, wiping out gains and shaking investor confidence nationwide. To the average American watching their 401k shrink or their mutual funds bleed red, it wasn't just another bad day on the market. It was a gut punch. As financial analysts rang the alarm bells, the optics of a president celebrating personal wealth while the economy faltered left many with a bitter taste. While the headlines focused on market drops, a far more unsettling signal was flashing just beneath the surface. The 10-year U.S. Treasury yield soared to 4.9%, a level that hadn't been touched since before the global pandemic paralyzed the economy. For those familiar with the language of markets, this wasn't just a statistic, it was a siren. Such a spike in long-term yields typically suggests that investors are demanding higher returns to offset looming risks, most notably, the rising probability of a recession. It was as if Wall Street had collectively decided, tough times are ahead, and it's time to brace for impact. Yet inside the White House, there appeared to be a striking disconnect. As billions evaporated in value, policy discussions seemed narrowly focused on image management and deflection. Trump's inner circle showed little urgency about the shifting financial landscape, prompting critics to question whether the administration truly grasped the gravity of the moment. Instead of pivoting to address the economic downturn, Trump chose to reaffirm one of his most controversial economic strategies, the trade war. He insisted that his tariff policies were working, that they were designed to bring jobs back to American soil and rebuild domestic industries hollowed out by decades of globalization. But the markets told a different story. The NASDAQ, home to the nation's leading tech giants, plummeted by 3.1%. Corporate juggernauts like Apple and Tesla, symbols of American innovation, suffered significant losses, down 5.6% and 4.8% respectively. Their decline wasn't just about stock prices. It was a sign that global supply chain pressures and higher import costs were beginning to erode competitiveness. Even outside the tech sector, the impact rippled outward. Walmart, long seen as a barometer of everyday consumer behavior, issued a chilling forecast. Tariffs were inflating prices across the board, forcing working-class families to make harder choices at the checkout line. In the eyes of many economists, this wasn't a battle the U.S. was winning. Instead, it was a high-stakes gamble that threatened to alienate trade partners, increase inflation, and deepen the financial strain on American households, all while the administration clung tightly to a strategy that appeared increasingly unsustainable. Even conservative media, typically sympathetic to Trump, began to shift its tone. On live television, a Fox News anchor commented with rare candor, "These policies are triggering instability we haven't seen in years. This is not economic revival, it's economic roulette." In a White House briefing that followed, Press Secretary Carolyn Leavitt tried to defend the tariffs with an unexpected spin. "They're not tax increases. They're actually a tax cut." The press corps wasn't buying it. One Fox reporter shot back, "Have you ever paid a tariff? Because Americans are footing the bill, not foreign governments." Their skepticism was supported by research from the American Enterprise Institute, which revealed that 98% of tariffs on Chinese goods were effectively absorbed by U.S. businesses and consumers. Since the new tariffs were enacted, import costs had ballooned by 17%, and inflation, once believed to be cooling, spiked again, with core prices rising 5.2% year over year. Leavitt, caught off guard by the data, offered a defensive retort. "I think you're insulting my economic knowledge." But the moment went viral, exposing the administration's increasingly shaky grip on the economic narrative. Even longtime allies began to distance themselves. Peter Doocy, a senior Fox correspondent and once a staunch supporter, admitted on air, "We're seeing a market reaction to dysfunction. Trump's own inner circle is now split on economic direction." The Federal Reserve added to the gloom with its latest report. The likelihood of a 2025 recession had surged to 65%. Unemployment ticked up to 4.6%, while Main Street businesses, already stretched thin, started letting workers go. Consumer confidence plummeted, reaching its lowest point in a year and a half. When reporters questioned the president about the spiraling economic situation, his response was brief and ambiguous. "We're going through a transition," he said. "These things take time." But the markets didn't respond to vague promises. Investors demanded clarity, and voters needed reassurance. Neither came. For many Americans, the contrast was striking. While Trump showcased luxury and defiance, families across the nation faced rising prices, shrinking savings, and job insecurity. The political optics were glaring. How could a leader appear so out of touch while the economic ground beneath his countrymen was crumbling? As Wall Street analysts recalculated risks and households reevaluated budgets, the 2025 economic saga was just beginning. And if current trends continued, Trump's joyride could turn into a political crash landing.